The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. There's no one I'd rather spend Valentine's Day with. It's my better half, Anthony McDonald. How are you, Anthony?
Oh, yes, James. Nearly 2 years and going strong. Love you too, mate.
Fantastic. Well, this week we extract four big themes from a massive week of profit result. We present the for and against cases for a rate cut and ask whether your taxpayer dollars should be used to bail out a broke airline. But first, Anthony, the big Australian has a new big kahuna. BHP announced on Wednesday that Chairman Ken McKenzie is going to retire and he'll be replaced by Ross McEwan, who listeners will remember was last seen as the CEO of National Australia Bank. Now, Anthony, this is big news in our circles. The change at the top of BHP is a really important thing in financial markets. But let's zoom out a little bit. What does a chairman of a big public company actually do? And do they really matter that much?
For sure they do, James. I mean, you know what they say, a fish rots from the head, and it's the same inside companies, and particularly so far as they're concerned as investments, which really, I mean, that's how we look at most things here on Chanticleer, James. I mean, the current BHP chairman, Ken McKenzie, I mean, he sort of used to like to say that the company gets the shareholders it deserves, and it's up to the chair to set the agenda, to explain it to shareholders, you know, explain the priorities for the board and management, oversee the governance structures, and bring all of the sort of context to management's decisions and make sure that management's fully aware of all the context around its decisions. So, James, the chair's a very important job. It's, it needs to maintain strong relationships with not just shareholders, but regulators, customers. You know, in this case, it'd be BHP's big Chinese buyers, with governments. He or she sort of really sets the tone. You know, they're a figurehead, James. They're a sounding board for management. Arguably their number one job is managing the CEO. You know, all the things from hiring to firing, counselling, preparing successors, all that stuff. But James, like a good chair, it's like a good referee in a football match. You know, if they're doing a job, you shouldn't really see them. Yeah. You know, you shouldn't really be too aware that they're there. They should just have everything sort of singing and going seamlessly. So, yeah, I think they're important. But, James, you got to know Ross McEwan a bit, obviously. You know, he ran NAB. He's the incoming BHP chair. What's he actually like?
Yeah, I think he's someone who's fairly understated, very down to earth, no airs and graces, still drives a Holden around, doesn't worry about the trappings of that top echelon of corporate life. He's actually quite like Ken McKenzie, who's similarly very direct, very, honest, very forthright in his views and pretty sort of, calls a spade a spade. I think you can see why BHP has gone for someone cut from a similar mould. I think Ross McEwan will see himself like as that referee you've just described. He would rather be well out of the limelight here, letting the business and the CEO do the talking and making sure everything's running smooth in the background. But I think there's a difference as we move from Ken McKenzie to Ross McEwan, and that's growth. Ken McKenzie's job has been to get this company, in tip-top shape, operational excellence, capital discipline, so not wasting money on silly things like the BHP of old used to do. But we saw last year BHP made that big bid for Anglo American that didn't work. Yep. $75 billion didn't come off, but it was a signal. I think you said this on the podcast. It's a signal that they need growth, they want growth. And so as we move to Ross McEwan, it's going to be his challenge to help the management team find their way into that growth. And it's not going to be easy. I mean, you think about how dramatic the last 4 weeks have been for a big global miner, with different story on tariffs coming out of the US every second day. This is some pretty rough waters he's sailing into. So be interesting to see how he goes.
Yeah. What do you think about jumping from banking? Like Ross McEwan's a banker. He was always a banker, right? From banking to mining. Yep. Right? Obviously in mining, you're digging up rocks. You're always looking to replenish your assets. In banking, I guess you're always turning over your loans, like people's loans expire, you're always, refilling the sort of funnel, but it's all about relationships. How do you think the two sort of cross over?
Oh, I think he'll be able to make the jump. There are some similarities. You ask anyone who's worked with Ross McEwan, like, what's his sort of skill, and people say his superpower is simplicity. He figures out what the most important 80% of the business is, and he really focuses on that rather than getting too caught up in the other 20%. And I think that'll serve him well at BHP. Yeah, it's a complex business, but you pretty soon figure out that there's a main game and lots of smaller games. So I think I think he can make the jump. You reckon he can do it?
Oh, for sure. That clarity of thought and the clarity of communication, I mean, that definitely struck me about Ross McEwan compared to the other CEOs we come across. Now, James, another fascinating story this week was around the collapsed airline Regional Express, which went under last year and has been on life support from the government. Now, Rex has taken on about $130 million worth of loans to keep this thing flying, its regional routes, which are often the only connection between the bush cities and towns and the major metropolitan areas. Now, James, this week, Anthony Albanese went a step further, announcing the government would support any potential bidders for the airline, and Rex itself should no other buyers be found. James, this sort of government support, it's quite remarkable, isn't it?
Oh, totally. So you and I and the rest of our listeners have already lent $130 million to this thing to keep it going, and now we're talking about buying it. Now, I get the sort of real politic here. These are very important regional routes. There's lots of votes in the bush. Where weeks out from an election, you can understand why Albanese is bending over backwards to make sure Rex, keeps flying and keeps flying till well after the election. But this is a great example of moral hazard. No one other than Rex is to blame for this airline's demise. They came out of COVID, and instead of just trying to manage their way through, like, say, Qantas did, and we know how much Qantas has been put through the ringer. These guys went and borrowed $150 million from a private equity firm up in Singapore and decided, hey, you know what we should do? We should take on Qantas and Virgin on the Melbourne, Sydney, Brisbane, Golden Triangle routes. Yeah. Because that has just worked so well for so many competitors. And guess what? They came a cropper. And now, just because they do own a bit of vital national infrastructure, the taxpayer is going to bail them out. I mean, there's lots of private companies that own vital pieces of national infrastructure. Do they all sit around and go, hey, guys, we should have a big swing for the fences here? Because if it all goes to poo, the government's going to stand behind us. I mean, this is the definition of moral hazard. And as I say, I get the politics, but there's so many calls on the budget. Now, we did a question on the podcast last week, Anthony, about NDIS fees. And we had a big response. We had a lot of health professionals writing in and pointing out that our wedding cake comparison last week wasn't exactly right. So this is where, NDIS fees are at $194, but most people go to the physio for $100. And as the health professionals who wrote in pointed out, we didn't quite get that comparison right. That $194 for the NDIS is an hourly rate. So if you put the private clinician fees on an hourly rate, it's probably more like $200 or more. Great point. But let's zoom out a bit. The NDIS needs lots of money. There's so many calls on the federal budget, and here we are bailing out a collapsed airline that took a big swing and missed. It doesn't sit that well with me. My only thing, Anthony, is that if the Australian taxpayer buys it, is there a dream scenario, where actually we make some money out of this thing? The regional routes were relatively profitable. Maybe this could be the new cash cow for the next government. What do you think?
You are an optimist, James. Rex will be able to cover the NDIS blowout over the next generation, you reckon?
Yeah, maybe not quite. I guess if the thing could wash its face, if it could break even, that'd be all right, wouldn't it?
I mean, that's a big if.
Yeah.
I mean, I think the question maybe should be, James, if the government's going to own it, are you better off just letting someone like Qantas buy it? It's obviously shocking for competition. Terrible. Absolutely terrible. But, I mean, what, you're going to have a government-funded airline? I mean, it's not remarkable at all. in this. What's not remarkable at all in this situation, James, is the fact that no one wants to buy it. There's good reason this thing's not flying out the door.
Yeah.
Isn't it? Like, it's subscale, it's expensive, it's heavily regulated, it's unionized workforce, big expensive aircraft, small addressable markets. Like, all this stuff just screams, don't invest. Yeah. And you got a big competitor in Qantas. Whoever buys it, what's your strategy? Is your strategy to be a price leader, product differentiation, premium service provider? Because whatever you choose, Qantas can crush you on any of those things,
Yeah.
So, I mean, it's sad because a lot of people need it because, like you say, they do have no viable alternative, but it's quite hard to see the business case.
Anthony, maybe we'll all get a shareholder discount on our airfares. That's another positive to take out of this.
Yes, indeed.
Anyway, we'll see where they go. Anthony, let's move to our first big topic of the week. And it's been a big week in the chook yard because we're back to reporting season. And this is when companies that are listed on the ASX have to present their results for the 6 months ended December 31 and give investors a sense of how they're tracking for the full financial year, which ends on June 30. Now, it's a very busy period, but it's a great chance to poke around in all sorts of corners of the economy, which we've been doing this week. Anthony, sum up the sort of vibe for us. How do you think the first big week of reporting season's gone?
The vibe so far, James. Well, it's not end of days bad and it's not boom times good. I think we're somewhere between muddling along and going okay. The consumer-facing companies, your Commonwealth Bank, JB Hi-Fi, car sales, the energy, the big utilities, AGL and Origin, they're holding up okay. The insurers, they're doing very well, maybe too well. Watch that space. The industrials, your favourite, James, SGH, which has Coates Hire, the WesTrac franchise that sells and services truck to miners. I mean, it's going very well. And the best example they had was with Boral, their cement business, where the margins increased about 20%, even in a soft demand environment. So for them, it's more a manage your way through situation.
Yep.
Down to the contractor, very solid. Maybe the disappointing bit, James, has been the offshore earners. The big Australian businesses with offshore earnings, your Macquarie's, your CSLs, Treasury Wines. They've been a bit mixed. Overall, though, James, more beats than misses by quite a long way. And coming into reporting season, I think the Morgan Stanley strategists were saying that this could be the trough in earnings. Like we've seen 3 financial years in a row where the earnings have got lower. They thought maybe this would be the reporting season where earnings sort of find their low and start bouncing out the other side. I'm not sure we're seeing evidence of that just yet. Like, there is a little bit of earnings growth around, but it's not huge. But we're not really seeing deterioration either. I don't think, James, we're really seeing big productivity gains across the board or any proof that AI has come to save Australia like, we keep hearing out of the US. So I think we're doing all right.
Yeah, we're trundling along. But nothing special.
Okay, James, why don't we break things down a little bit further for our dear listeners and pick 2 trends each from the week that was. Okay. James, let's start with you.
All right. So the big result, the biggest company on the ASX, CBA, shares just keep running. We've talked about its crazy valuation ad nauseum. Yep. But look, one interesting thing that CBA is doing is how it's selling its mortgages. Now, if you think of the mortgage market as a whole, we've become dominated by mortgage brokers in the last 10, 15 years. 75% of every home loan, of all the home loans in Australia, are sold via brokers. CBA is going the other way.
Yeah, right.
They're still selling 66% of their mortgages through their own channels. So through proprietary channels, that might be CBA or Bankwest. So that's a very big contrarian view on the market. Now, why do they do that? Well, a broker sold mortgage is about 20 to 30% less profitable than a mortgage that CBA sells through its own proprietary channels. So they are making a very concerted effort to sort of kick against this trend and reap some profitability benefits. They're using those profitability benefits, it appears, to compete harder in the market and grow volume and market share. So it's just interesting to see that strategy, and it all comes back to that huge customer franchise that CBA's built. 35% of Australians are CBA customers or call CBA their main financial institution. But one great point from Barrenjoey's veteran banking analyst, Jonathan Mott, he's been looking at the banks forever, absolute guru. He points out that where CBA is really selling a lot of loans is to rich investors.
Yeah.
So get this, mortgages for investors earning between 200 grand and 500 grand per household, they surged 59% in the 6 months ended December. Loans to investors where the household's earning more than 500,000, they were up 166%.
Jeez.
If nothing else, it just shows you how badly younger and less wealthy households are locked out of the market at the moment. Maybe that'll change as an interest rate cut comes through, but it's rich investors who hold the whip hand at the moment. Anthony, what about you?
Well, it sounds there like the gold-plated bank's got the gold-plated customers, James.
Yeah, that's right.
Well, I mean, obviously tariffs has been a big topic. I don't think either of us would have written a column this week without the word tariff in it. But we got a good reminder from a few companies, James, that we've been here before on the tariffs. The last time Trump was around, there was tariffs. The tariffs have been here for about 3 minutes, but we've seen a lot of companies saying they've had months to prepare, been here before. And they're doing things to sort of get around them. And I'll give you an example, James, and it's a favour of the podcast. Remember old Breville?
Yes.
The company that makes the coffee machines?
Yes.
And I think we spoke last reporting season about how they were selling an $1,800 coffee machine and it was doing really well. It's a bit of a postscript to that, James. I found someone at the AFR who actually owns one of those coffee machines.
Really?
They must have won the lottery, yeah. But anyway, so Breville does a lot of manufacturing in China and it sells in America, right? So coffee machines, toasted sandwich makers, all that stuff.
Yep.
But what it's been doing, James, and it says it's been shifting this way for a while. So anything that has a 120 volt power point. Now, they're those funny looking power points you need when you go to the US, James, when you travel overseas.
Yes.
So basically anything that they sell into the US, they will have 2 manufacturing points. They'll have one in China and one outside of China. And then all the stuff that goes into the US, that can come from the non-China factory, say in Sri Lanka or something, to avoid the tariffs. While the Chinese stuff they can go to other parts of the world. And it's a practical sort of solution.
Clever.
And I think the market believes that it's going to be relatively unaffected. Breville shares have been strong. I mean, you just naturally think the tariffs would be bad for them. But they said 45% of their trades in that China-US route as at July this year.
Right.
And it'll get to 10% by next year. So
they can manage it.
They're getting around it.
There's practical ways. Yeah, it's interesting.
Yeah. What else have you got for us?
Well, look, a bit of a lighter one. Treasury Wine Estates, they had a bit of a middling result yesterday. The market didn't love it. I think the stock was off 5%. Bit of concerns about their outlook for the rest of the year. But what's interesting to me, as if any of our listeners sit down and crack a bottle of wine this week, it's probably going to be a more expensive bottle of wine because the wine market has become increasingly bifurcated. The bottles under $15 a bottle, and that can be $15 US or Australian, doesn't really matter. They are doing terrible business. Everything above $15 a bottle is going great guns, and the more expensive the wine gets, the better it seems to go for Treasury Wine Estates. So this is really interesting to me because if you think about what we've heard from all the department stores and particularly the supermarkets, a lot about how consumers are trading down to cheaper options.
Yeah.
Instead of buying the porterhouse steak, they're buying the mince.
Yeah.
But it's not happening in wine. In fact, it's going the other way. It's getting harder and harder to sell the cheap plonk. Why is that? Well, it's probably a little bit about a generational shift. People want to drink less and drink better, and a bit of a health thing too. Instead of having, I don't know, a couple of bottles of wine a week, you spend a bit more on a single bottle of wine and enjoy it a bit more. But it's interesting, Anthony. It's a tough time to be rolling out casks of wine or cheap bottles.
Is that consistent with the Thompson family cellar, James?
We're not big wine drinkers, but yeah, I guess it is. And you think about when you go out to dinner or, most people will splurge a bit more to get something a bit nicer, knowing that they're not drinking as much. So, yeah, I think it's it might not be good for our wallets, but it's probably good for the health of the country, maybe. Anthony, you got another one for us?
Yeah, James, my second one, and it's something I didn't expect, James, because the cost of everything's going up. Like, when was the last time you bought something and you were like, gee, that was cheaper than expected? It just doesn't happen, right?
2016.
Yeah, there's something out there that's cheaper, James. We heard it. We heard it from two big companies.
Right.
And that's batteries. And not just any old batteries, but these giant batteries that AGL and Origin are building to store huge amounts of power. You know, they store it for 2 to 4 hours.
Right.
Like, both of these companies are rushing them out. Like, they need to replace that reliable, firm power they have from the coal-fired power plants, and they're using batteries to do it. I mean, batteries, obviously, James, they don't generate the power, but they do store it. You can take, wind at windy times or solar when the sun's shining, and then store it for 2 to 4 hours in these batteries, and then release that, as everyone gets home from work and they turn on the oven, the TV, the air conditioner, the cooked up the washing machine, the dishwasher, all that stuff.
Yeah.
So these big batteries, James, and you can see this in their cost estimates, they're 30 to 40% cheaper than they were a couple of years ago.
Wow.
To build.
And is that about lithium prices and rare earth prices have come off? Is that feeding through to that?
Exactly it, James. It's a lithium price.
Right.
They had a huge reduction. It's more than halved. So AGL and Origin are pumping them out while they can. Origin spent $560 million on building batteries in the 6 months to December 31. I mean, that's probably the peak of what it'll spend on batteries.
Yeah.
It's in its entire lifetime. AGL signed off on more than $1 billion worth of new projects. So it's quite remarkable, James. And I mean, AGL's boss, Damien Nix, he pointed out that 30 to 40% number, ran it past Origin's Frank Calabria, and he said, yeah, absolutely. So,
wow.
Yeah, it was good to see. Now, James, great trends. We heard from you there. Was there anything you came across in reporting season that surprised you?
I've got some good news, Anthony.
Yeah.
You know how galling it's been to open the insurance policy renewal over the last year?
Yep.
It's going to get a little bit less painful.
Okay.
What we've seen is the market has reset. So global reinsurers have pushed up prices for Australian insurers, but that's been reset now. It's stabilised. We're starting to see claims costs come down. And so what we saw from IAG, which big insurer owns NRMA and a bunch of other brands, its price increases have come down from 15 to 17% just 6 months ago, now down towards 6.5%. That's a staggering fall. I mean, still no one enjoys paying 6% extra for their insurance. I totally get that.
Yeah.
But the rates of growth have really come off. And I think that's a bit of a sign, another sign of how some of these big inflationary forces are just starting to work their way out of the economy. And that's going to be welcome for people, I think. What about you? Did you spot a little surprise?
Yeah, Car Group. So it owns car sales. They've got a big business in the US as well called Trader Interactive. Now the US business, it's like a car sales type business, except instead of cars, it's more RVs, jet skis, more high powered sort of toys that are sold through dealers.
Yep.
Now the peak time to buy that stuff in the US is kind of now in the next couple of months. They're just coming out of winter. You sort of buy them and going into summer, and then sort of use them over summer. Now normally, car would put through its price rises in March, right? So just ahead of that peak, just to make sure that they're picking up that peak and creaming it off the dealers. But they've actually delayed the price rises a couple of months, James. And they think it's because the dealers need a bit of a hand because it's a bit soft out there.
Right.
There's not going to be as much buying going on. And Cochlear this morning, James, I mean, it came out and said, it cut its guidance and then it blamed the cost of living pressures on the US customers. So it surprises me, James, because we keep hearing how good the economy is over there. We keep hearing this term, US exceptionalism, this sort of like Team USA, Trump firing up the Americans, all that stuff. But on the ground, it's obviously a little bit soggy underneath. Yeah. I mean, as we saw in the election, people feel like they need a bit of a hand, and then businesses like Car are sort of showing us that they do. And once again, James, this comes back to this point that you bring up quite a bit. And if your central bank's cutting rates, it's probably cutting them for a reason.
Yeah.
Okay, James, for our second topic, let's take all of this from reporting season and try and put it to use. It's a huge week coming up for the Reserve Bank of Australia board, which will make its first interest rates call for the year. James, it's a monster decision. The bank's had rates unchanged since November 2023. And the government's sweating on a cut to launch its re-election campaign. James, the bond market, economists, all sorts of pundits, including yourself, are tipping a rate cut here, which would be the first rate cut in 4.5 years. Now, you've been in the February 2025 camp for more than a year.
I have.
Well, most economists and bond markets have joined you in the past 8 weeks as the December quarter economic data landed. Now, James, we'll discuss the pros and cons of a rate cut and retest your guidance. But first, can you tell us, what have we seen from our biggest companies in reporting season this week that could help the RBA board decide whether it needs to cut rates or not at its meeting next Monday and Tuesday?
I think we've seen very few signs of a deteriorating consumer.
Mm-hmm.
So the consumer is doing okay. In fact, they're probably doing better than okay. I mean, CommBank had some good data about how tax cuts, the stage 3 tax cuts last year, have been largely saved by most households, and that has flowed through to offset accounts. So, okay, they haven't been spent, but there's a big buffer there, and there's a big buffer sort of ready to be spent, I reckon, when people get a sense that rates are coming down, there's a bit more stability about the economy. You look at JB Hi-Fi's sales. I mean, we're growing like-for-like sales in the first 5 weeks of the new calendar year, 7%.
Yeah,
That says to me that there's no, people are still buying phones and small appliances and big TV screens. I don't think that's the sign of a struggling consumer. So I think if the RBA is reading these results as closely as we are, Anthony, they're probably sitting there thinking, maybe it's not quite as weak as we thought. So I think that's the danger for them as they go into next week, that they've got to balance this soft inflation reading that they got a couple of weeks ago with these signs from the economy that employment's still very strong and the consumer's still holding up. It's a really tough one. And yet you look at the bond market, what are they saying? 95% chance of a rate cut next Tuesday. It's black caviar odds, as our old editor Michael Stutchbury described it this week. This is a really tough one. Should we break it down, Anthony?
Yeah, good idea, James. Like, obviously the RBA board, it's going to do one of two things, right? It's going to keep rates on hold, or it's going to cut rates. Yeah, let's look at the case for each argument, and we'll start with you, James. What's the case for maintaining the status quo, keeping rates at 4.35%?
Yeah. Now, Anthony, I've been saying the first cut will come in February for like over a year. I'm going to be right, but I'm worried I'm going to be right for the wrong reasons.
Uh-huh.
I think the case for holding rates steady, for not delivering a cut, is that the economy is still too strong. The inflation dragon has not been slayed. We've seen basically 1 quarter of better inflation numbers. And if you look at what we got in the US this week, what we're seeing is rate cuts in September there seem to have made inflation even more sticky in the last couple of months. So I think the RBA, the most embarrassing thing for the RBA here would be to cut rates and then in a couple of months have to turn around and go, whoops, inflation's got out of control, governments are still spending, the labour market's still really strong, the consumer's doing all right. I think we're going to have to nudge them up again. That would just be super embarrassing for the RBA. They don't want to do that. I think they'd be better to sit on their hands for a little bit longer and try and be more certain that American experience with inflation is not going to be repeated down here, that inflation's actually coming down sustainably towards that 2.5% goal. Anthony, what's the case for a cut?
Okay, James, the case for a cut, it's all about inflation. So headline inflation was running at 2.4% in the December quarter. If you look at a year-on-year basis, the trimmed mean inflation, which is what the RBA prefers to look at, was running at 3.2% on a year-on-year basis. Now, that 3.2% was the slowest increase since 2021, James. Now, remember the rate started rising in May 2022. So then that 3.2% for the December quarter was less than what the RBA had forecast. They thought it'd be 3.4%. Now, that 0.22%, James, is actually quite a meaningful difference.
Yeah.
Now, James, that 3.2%, obviously it's not within the RBA's 2 to 3% band, or it's, the 2.5% sort of cycle through the target. But the December numbers clearly show that inflation was trending down and it's on track based on what we saw last year to get back to within the band. Now, James, remember the RBA has a dual mandate, right? It looks at inflation, which we've just been through, and jobs.
Yep.
On the job side, the labour market's still really strong. The unemployment rate's 4%. Employment growth and hours work were up 3% in December, right? So the jobs market is tight. At 4%, the unemployment rate, that's less than what the RBA thought it'd be. The RBA thought it'd be 4.3%. It's less than what most people would tell you the sort of neutral rate is, which is about 4.5%. So basically, it suggests the economy is still running a little bit hot. So, James, I guess the market must be looking at the inflation side of the equation, right?
Sure, for
and
sure.
saying, look, the inflation's come back. But James, I would say the number one case for a rate cut now is just the market expectations.
Yeah.
The market, and when I'm talking about the market, I'm talking about the 30-day interbank cash futures, so which is just a bet on the next interest rate call, really.
Yeah.
As of this morning, it was saying a 90% chance of a cut. It was at 95% for most of the past fortnights. 90%, that's still a lot.
Yeah.
And that's the number one reason for a rate cut, James. When the market is so heavily positioned on that one side, what would happen if the RBA didn't cut?
Yeah.
What would that say about the RBA's supposedly new communication strategy? It's 8 meetings a year strategy, which is only new, that the market could read what it said and the data and how it thinks about the data so wrong.
Yeah. No, I think you're absolutely right. So let's get you off the fence. Your prediction on Tuesday, definitely a cut?
Mate, if I was an RBA board member, I'd be hold every day of the week.
Yep. But do you think there'll be a cut? But do you think there'll be a cut or not? Come on.
There's got to be, but I just I struggle to say yes to that. It just feels wrong coming out of my mouth. Do you know what I mean?
I know exactly what you mean.
Yeah.
I know exactly what you mean, but I think there's going to be a cut for the reasons you've just given. I know Cecile Lafort, our bond specialist at the Fin, gun member of the markets team. She had a great piece yesterday saying the radio silence from the RBA is telling. If they wanted to sort of suggest to the market that you've got it wrong, they would have done so by now by some method, whether it's some well-placed off-the-record comments, or maybe they'd find an excuse to come out and say something, but they've done none of that. So I think we're headed for a cut. But I'm with you. I think it's a lot more of a line ball decision than it appears from looking at the bond market.
This is a massive decision, James.
Yeah,
Huge. Think about the election.
Yeah,
if not just the economy.
Yeah, totally. Anthony, we've got I know we usually take questions at the end of the pod, but we've got an audio question from Jason from South Australia, which relates to rates. Let's take it now.
Good morning, guys. Keep up the good work with the podcast. It is now a weekend ritual to listen while on the mower in the garden to recap the week in business. My question is, what are the chances of the RBA going for a minor 0.1% cut next week, the signal intent to drop and remain there for the rest of the year? It would also bring rates back in traditional lines, having an even quarter like it always has. I like the look of 4.25% rather than 4.1%. Call me a traditionalist if you must. Regards, Jason Soil from Mount Gambier in South Australia.
Well, Anthony, not only does Jason live in a beautiful part of the world, Mount Gambier, it's a great place. I reckon he solved Michelle Bullock's problem here. This is it. She can just do a little cut, a mini cut, bring us back into the round numbers, and not sort of disappoint anyone. This is the way to go, isn't it?
Roll out the nil-all draw and disappoint everyone, James. For what it's worth, I think that's a great question. Let's get back on the 0.25 cycle.
Yeah, it is. There's a couple of good questions here. Would this be an option? I don't think so. I think they've signalled, a 0.25% cut's more likely. But at some stage, Jason's right. At some stage, I think they'll want to get back to the round numbers. So is it at this point? Probably not. I think it's probably at a latter point, and maybe a smaller rate rise at some point down the track might work in a future governor's favour. But it's an interesting idea. And Jason, keep the mower straight and know that you might have solved one for Team Australia here. Good thinking. All right, Anthony, we'll come back after the break. Another big week looms next week, centred around RBA Day on Tuesday, but it's a bumper week for results. We'll be back to have a look in a second. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, we've talked a lot about RBA rate day on Tuesday, and I should just note, we actually get employment data on Thursday. I wonder if a bit late. I wonder if the RBA gets an early look. But that'll be really important for that whole story about how strong the labour market is. So watch out for that too. But it's a huge week of results. Miners come into focus next week. BHP on Tuesday, and then on Thursday morning at 5 a.m, Rio Tinto is producing their results. We've also got Telstra, host of consumer companies. Anyone you're particularly looking forward to?
For entertainment reasons, James, Mineral Resources, like the CEO, Chris Ellison, is highly entertaining at the best of times. He's been through the ringer in recent months, so it'll be interesting to see if he's even more entertaining or less. Goodman Group, let's see how its data centre plans are going. Wesfarmers, always good.
Yeah,
there's
Wesfarmers.
Plenty on, James.
Yeah, good call. All right. Well, we took our question earlier in the podcast, but if you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form, as Jason did this week. Just record a voice memo on your phone, include your name and where you're from, and email it to us. Anthony, it's been a huge week of results, and next week, as you say, it's just going to be so pivotal. Tuesday afternoon, 2:30 p.m, and then Michelle Bullock's press conference to follow. It's going to be huge.
Absolutely.
Happy Valentine's Day to you and to our listeners. We'll see you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.